Hi class. What we're going to do now is we're going to do a video that completes chapter 7, and we'll mostly focus on Notes Receivable. But before I go to Notes Receivable, I want to just do a little summary of what we did last video. And that has to do with the idea of there are two methods for writing off bad debt expense. The first method, of course, is the direct write-off method, and that's the one where as soon as you have a bad debt expense, you declare that it's uncollectible, you write it off, bad debt expense, accounts receivable. And then, of course, if anything happens and the customer happens to repay you, you have journal entries to reinstate the account and then collect the cash. Have an entry to show you collect the cash. The other method is the one we spend most of the time on, and that's the allowance method. And the allowance method had two ways of estimating the bad debt expense, and that was the sales method and the aging method. And the adjusting entry in both cases looks like this: bad debt expense, allowance for uncollectible accounts. Now here's something we didn't talk about, and that's as time passes, you're going to have different accounts that you declare uncollectible. And at that point, you're going to debit allowance for uncollectible accounts, and you're going to credit the accounts receivable for that particular customer. Okay, so this will come up in the homework and on the exams, and I'll do a video that shows how to do specific problems. And the same journal entry then, if somebody who you've declared is not going to pay you now does pay you, you just simply reverse the account, the journal entry up here, and then account for the cash. Okay, the last thing about accounts receivable is how it's presented at the balance sheet. You can see we talked about the net realizable value. It can either be presented where you show the accounts receivable less the uncollectible accounts, or you just show this and you tell the reader that that was the allowance amount. Now, notes receivable is something that's a little different, and the reason it's different is because a note receivable is a promissory note where you're going to actually pay interest. So the maker of the note is the bank, or it's the company that's lending the money or is lending, paying for the goods or services. The payee of the note, that's who has to pay it. The principal is the amount you're borrowing, or the amount that, in this case, you're loaning. The amount of interest, the interest rate, when it has to be paid, and of course the maturity value, which is the principal plus the interest. So these are the terms of the note. So a very simple note or a promissory note would look something like this. Here again is your principal. This is the beginning of the interest period. So you start counting up the interest. Again, the principal, this is, in other words, if you're giving this amount to a customer or to somebody, it's the amount you gave them. This is the interest rate. Okay. And of course, this is the maker of the note, or this is the payee of the note, and this is the maker of the note. Now, you would use a note receivable in 3 specific incidents. So you can use it for lending money as a way of providing goods and services. In other words, I sell you my computers, and instead of cash or accounts receivable, we do a promissory note, a note receivable. Or sometimes what happens is there's an account receivable and you want to permit more time, but you want to collect interest now on that additional time, and so you make a promissory note. So an account receivable becomes a promissory note. And I'll do a video that shows all 3 of these. Now, the most difficult part of a note receivable has to do when you have 2 different time periods. In other words, this is the end of December 31st, and you have to make up your financial statements. And it's from March 31st to December 31st, and this is a 12-month promissory note. So we have to do an adjusting entry on December 31st for the 9 months that have already passed, from March 31st to December 31st. Now, when you calculate interest, it can either be on a monthly basis, or typically what our book uses is a 360-day. And if it's months, it'll tell you the problem in months. If it's by days, it'll use the number of days, and it'll usually tell you it's 360 days. This would be calculated, as you can see, the principal times the interest times the amount of interest that's accrued, which is 9 out of 12 months. The other difficult part is when you have 2 time periods and the note is paid off, you have to account for the total amount, which is the maturity value here, and you do that by adding up what is the amount in the note receivable, the interest receivable that you accrued, and the remaining interest revenue, which, as you can see, is now the additional 3 months of interest that you're going to receive. So these are the 2 most difficult parts, and I felt it was better just to show you how to do a problem that I will attach to this. Okay, so here's a good practice problem that kind of covers everything in Notes Receivable. And the problem says record the following transaction in the journal of Sounds and Wheels Incorporated. Explanations are not required. And it's going to use a 360-day year for the interest computations. Okay, so here's a list of all the journal entries we're going to be doing. And I'll get rid of that, and I'll do them one by one. So the first one says we received a note, 90-day 6% note from AJ or JA Audio, and because it says on account, we know what that means. We know that means that we're now going to exchange our account receivable for a note receivable. They need extra time, we're going to give it to them. So we're going to debit Notes Receivable. It's an asset, so when we increase it, we debit it, and we're going to take the account receivable off the books for the $3,800. So that's one of the 3 ways we talked about doing a note receivable, and this was simply to switch out an account receivable for a note receivable. Now the next thing is we have this adjusting journal entry, and that's going to be a 15, or I should say 25 days. If you notice, from December 6th to December 31st, that's 25 days. And you do that by taking the principal, which in this case is $3,800, multiply it by whatever the interest rate is, and this is a 6% note, so that's 0.06. So we know the annual interest is $228, and then we multiply that by the number of days. So from the 6th to the 31st is 25 days, divided by 360-day year, and we round off to the nearest dollar, so that's $16. Now, in March 5th, we're now going to pay off this note. Okay, so when we pay off the note, we're going to collect cash for all of the principal, which is the note receivable, for the interest receivable we established on December 31st, and then the interest revenue that we earned from January 1st to March 5th. Okay, so these we already are given. Okay, now the only one we have to calculate is how much is going to be the interest. So that's 3,800 times 0.06 times to March 5th is going to be a total of January's 31 days, February 28 days, and then March 5th, I think that's 64. Okay, so round off, it's $41. And you typically will add these three up in order to get the cash. So again, this is how you pay off a note receivable that is in 2 time periods, which means we had an adjusting entry right here. Now the next journal entry is we loaned cash receiving a 6 month. So here's the second type where we actually loan somebody cash. Note receivable cash. Here's one where we received a $32.50 on a 120-day 9% note on its past accounts receivable. So this is like the first one where we're exchanging the accounts receivable. We don't want to write this off as a bad debt, but we want to collect interest because they're not paying us off in time. So that journal entry is just like the first one. And then we come to December 1st, where we're going to collect the maturity value of the master note. So that's this one right here, $2,000 one. And because this is within one period, we don't have to go through all of that other calculation. Also, notice this was received on a 6-month note. So instead of having to use 360-day year because they designated a 6-month note, our calculation will be 2,000 times, and this one is an 8% note, so times 8%. That'd be the total amount. And then we're going to multiply this times 6 divided by 12. The interest is $80. Add that to the principal, and it comes out to $2,080. And then the last one is just another adjusting entry. So here we go. It's December 31st. We have this outstanding note right here for $3,250. And so we have to make up this adjusting entry. Now, this is something I want to show you real fast. So this is $3,200, and let me clear it. This is $3,250, and it's going to be times the interest is 9%. So this is times 0.09. This is the annual interest, and now I'm going to multiply this by, believe it or not, October 31st to December 31st is actually 61 days. 61 days divided by 360 is 49.56 rounded up. Now, when I first did this problem, I could not figure out why that was off by a few dollars. So that's what you use the help me solve this for. If you look, I went over here real fast and I just skipped ahead to the part that I didn't understand. I had everything figured out, and if you haven't become an expert at help me solve this, do yourself a favor and learn how to use this tool because it will help you immensely. Okay, so notice, get all the way down to the last problem, and it tells me that I had to use 61 days because, and it explains it in here. So if you want to know, well, why is that true? Well, it explains in here that remember not to include October 31 as your days. So it explains that it was 30 days and then 31 days for a total of 61 days. Okay, class, that's it for Chapter 7.